In this lecture, we are going to study a critical aspect of human psychology applied to decision theory in the financial markets, which comes from the understanding of the prospect theory. The prospect theory is so important that it won a Nobel Prize in economics, and it was discovered by a psychologist, which is the man you see in this picture who happens to be a leading authority in behavioral economics. There are two modes of reaction a trader can have when facing a decision in the market, roughly speaking. The trader can seek risk, or he can avoid risk. The hallmark of the prospect theory is that it shows how a person can shift between these two modes regarding the same scenario. The only thing that makes the person shift between risk avoidance or risk seeking is how the decision is framed. In other words, the way in which a person sees a decision is what determines if she is going to seek risk or avoid risk. The interesting thing about this is that the person can shift between risk aversion or risk seeking behavior just based on how the situation presents itself. That happens because human beings make decisions based on something called heuristics, which are simplistic and automatic decision-making rules that run automatically in the brain. These heuristics are effortless and second nature to us because human beings evolved over thousands of years with a need to make decisions in the quickest way possible, which does not mean these decisions will be made in the best way possible. These are two completely different things. The field of evolutionary psychology claims that our ancestors had to make quick decisions to avoid dangerous situations, and that's how these mechanisms got engraved in our nervous system. As we will see in future lectures, the presence of these heuristics and cognitive biases is a paradoxical practical necessity of our existence, but let's leave that to a moment where we can focus more precisely on why that's the case. For this lecture, it's important to understand the core and axioms of the prospect theory. The heuristics and biases associated with the decision-making process are wrapped by something called bounded rationality, which is composed of three elements. The available amount of information in the moment a decision is made, the time constraint that envelops the decision-making process, and the cognitive limitations of the person making such decision. In trading, all three elements of the bounded rationality are attacked in unfortunate angles. For example, the amount of information a person has to make decisions in the market is indeed limited. That's the problem that high-quality technical analysis attempts to solve, and it is already a big challenge by itself. The time constraint of the decision-making process is also a problem in the markets because traders are always running against the clock, which is a reliable way of augmenting the effect of negative cognitive biases and the overall anxiety level of a trader. The cognitive limitations of a trader are no different than the cognitive limitations of anybody else, but a trader tends to put himself in situations where his counterproductive biases get amplified. This almost always ends badly because our biases are not exactly designed to be rational. They are a byproduct of biological evolution to get us out of primitive versions of trouble. Once again, this refers back to the paradoxical nature of modern social animals like us with primitive cognitive biases. To truly understand what the prospect theory means in practice, we can do a few different exercises to show how we can seek or avoid risk depending on how decision-making questions are framed. Consider the two following alternatives and choose the one you prefer. Number 1. 95% chance of winning $100,000. Number 2. 100% chance of winning $94,499. Let your intuition guide you and pick one of the two alternatives. If you are like most people, you probably chose alternative number 2. However, mathematically, and statistically speaking, the alternative that makes the most sense is alternative number 1. Before showing you what that means, let me explain what this example means under the light of the prospect theory. The fact that we generally feel better choosing alternative number 2 shows us how we tend to avoid risk depending on how the question is framed. Most people pick alternative number 2 because of the fear of disappointment. However, statistically speaking, the correct alternative is alternative number 1 because 95% of 100,000 produces $95,000 over a series of equal decisions while 100% of 94,499 produces $94,499, which is less money. The key here is not to pay attention to what the numbers feel like gauged by our intuitions, but to use mathematics and statistics to discover what the decisions really look like over time. Most people choose the alternative that does not make sense under the light of mathematics and statistics because these things are not part of our intuition. Let's look at a different question to see other types of reactions people might have about this framing problem. Consider the two following alternatives. Number 1. 5% chance of losing $100,000. Number 2. 100% chance of losing $5,100. Once again, this is a question framed to spark risk aversion or risk avoidance. Most people tend to choose alternative number 2 simply because our intuitions guide us to the impression that it is better to leave with a certain small loss than to have the possibility of losing a larger amount. As correct as this might sound, it is mathematically and statistically incorrect. If we analyze these alternatives over a series of equal decisions, we will see that 5% of losing $100,000 makes you lose $5,000 over time, while 100% chance of losing $5,100 guarantees that you will lose $5,100, which is a bigger amount to lose, and therefore an undesirable outcome. After the first exercise, you already know that you should look at these problems using simple mathematics, so you probably picked the correct answer. However, it's amazing to notice how people choose alternative number 2 due to the fear of a large loss. These are the 2 classic examples of questions framed to provoke risk aversion in most people. Let's now look at 2 classic examples of questions that provoke risk-seeking behavior. Consider the 2 following alternatives. Number 1. 5% chance of winning $100,000. Number 2. 100% chance of winning $5,100. From the last 2 examples, you already know that you should look at this problem under the light of mathematics and statistics, and therefore, you should be able to see that the correct answer is alternative number 2. That's the case because over a series of equal decisions like this, 5% chance of winning $100,000 generates $5,000 while 100% chance of winning $5,100 generates $5,100, which is more money, and therefore, a more desirable outcome. However, as you might be expecting already, most people choose alternative number 1 in the hope of winning a large amount of money. In other words, by listening to their intuitions, most people end up seeking risk unnecessarily. Once again, most people choose the wrong alternative because they are thinking intuitively, not mathematically and statistically. Let's look at a final example that provokes risk-seeking behavior. Consider the 2 following alternatives. Number 1. 95% chance of losing $100,000. Number 2. 100% chance of losing $94,499. Most people choose alternative number 1 in the attempt to avoid a certain loss. However, we know that alternative number 2 makes us lose less money in a series of equal decisions like this. As you can notice by these 4 examples, the way decision-making questions are framed using different lenses of high or low probability, winning or losing scenarios, and high or low amounts of money deeply affect the way our heuristics lead us to make choices. It's only through the unbiased lenses of mathematics and statistics that we can erase this effect. Another interesting thing that the prospect theory points out is the asymmetrical shape of the utility function. In simpler terms, imagine that we can attribute a psychological value for wins and losses. The asymmetrical shape of a utility function tells us that winning $100 feels 100 points in the imaginary scale of psychological comfort. However, losing $100 feels more than 100 negative points in the same scale. In other words, winning $100 is not symmetrical to the experience of losing $100. There is a lot to be said about the relation between the prospect theory and the idea of using optimal risk-reward ratios over time in trading. Many traders feel uncomfortable with the idea of using a good risk-reward ratio because their win rates are diminished. That happens simply because it's a lot easier for the market to hit a small stop than to hit a large profit target. This is where the concept of trade location comes into play to save the day and balance things out. Let's observe the prospect theory in 2 distinct risk configurations in the market. One is a very irresponsible scalping paradigm in which the trader aims for an extremely high win rate, so his stop-loss orders are large and his take-profit orders are short. The other risk configuration is a more sophisticated one where the trader maintains the ratios between 1:3 and 1:5. This naturally produces a lower win rate, but it guarantees the trader stays in the game indefinitely, unlike the first configuration that is short-lived. The main difference here is that the first risk configuration fails to recognize the importance of projecting decisions over time, which is the main thing that makes most people answer decision-making questions incorrectly. It feels a lot better to make quick and immediate rewards in the market, but that feeling does not last very long. On the other hand, the second risk configuration takes into consideration the mathematical and statistical side of the decision-making process and bypasses the erroneous intuitive feeling that comes from generating a lower win rate. One of the most important lessons a trader can learn is the maturity to grasp the idea that sacrificing an exceptionally high win rate is a practical necessity to make money in the long term. There is no way around the laws of mathematics and statistics. Now you know how your brain can trick you into making the wrong decisions based on what you feel instead of basing your decision-making device on what is universally accepted as reasonable according to mathematics and statistics. In the next lecture, we are going to explore something called the intelligence paradox.